Good morning, everyone. My name is Sakib Ryan, a resident crude oil trader here at JNF Capital. I'll be looking to give you an insight into what's happening in crude oil at the moment as far as the prices are concerned. Today's date is Monday, 2nd March 2015. Before I get started, I would like to let you know that investing in the financial markets is not for everyone, as losses can exceed the deposit. As you already know, I like to basically consider both sides of an argument. Markets are made up of both bulls and bears. So my job as a trader is to simply identify which entity is in control and look to align my funds in the same direction. Now, this last 4 to 5 weeks, whole of February, crude oil has been exceptionally range bound. It's stuck in a range between around 48.60 and 53.59. So just literally bouncing off that. Main reasons is that both the bulls and the bears have good arguments for why the market should be going up or down. Now, as long as we're in that range, I take a neutral stance in the market. That means I will not be bearish or bullish until I see a clean breakout, both fundamentally and technically, of this range. Okay, so what are the bears focusing in on? Basically, the status quo for the whole of February has been pretty much quite stable. Okay, the traders are generally focusing in on inventories on Wednesdays and rig counts on Fridays. Okay, so what you'll find is generally the inventories that tend to build on a Wednesday, the market sells off, and then the rig counts drop on Fridays and the market picks up again. Okay, now as far as the actual stats are concerned, let's have a look at the inventories. We were expecting a build of somewhere in the region of about 3.6 million barrels. Okay, however, the API figures that are released by the American Petroleum Institute on Tuesday night said that there would be indicated that the build will be somewhere in the region of about 8.3 million barrels. Okay, so on Tuesday night last week, the market sold off quite hard, and then on Wednesday, when we actually had the government figure come out from the EIA, the figure was somewhere in the region of about 8.4 million barrels. So the API wasn't so far at all. So when the figure actually came out, the market didn't really sell off anymore because it had been, the build had already been priced in from the night before. So what this tells us is that that's the seventh straight week of builds and inventories. Stocks at Cushing, Oklahoma, continue to build. The SPR is the Strategic Petroleum Reserve somewhere up at about 434 million barrels now, and we're edging closer and closer to its maximum capacity. Okay, inventories keep on building. That means that not enough oil is being consumed. I've already discussed why it's not being consumed. The demand is just not as strong as the supply at the moment. Okay, looking at the rig counts again from Baker Hughes on Friday, we had the rig counts out. Okay, we have seen another decline of another drop in rig counts. Okay, so it drew about 43 rigs went offline last week. Week before that, it had, we had dropped about to 48 rigs had been cut. That brings a tally to somewhere in the region of about 1,267 rigs, I believe, have been taken down. Now, of course, like I've explained before, although this is generally bullish information, what we have to consider is that despite the rigs actually coming offline, the actual production is not that much different from before the rig started declining, specifically because the production is still being held. So even though the rigs are falling, a lot of the producers are forced to keep drilling, as I explained last week, in order to meet their lease agreements. And otherwise they lose acreage, right? They lose some of the land that they're drilling on. So which obviously could be a valuable asset going forward. So yes, they are cutting down on the rigs, but the production figure is not really changing much. Okay, so that to me is a bearish piece of information. Another thing is the dollar. The dollar has been exceptionally strong. It remains very strong. The Fed is talking about raising interest rates, but however, last week they said that they won't be raising interest rates anytime soon. So what does that tell you? It tells you that yes, they will be raising interest rates, but not anytime soon, which means that the dollar started to stabilize. It hasn't broken up any higher, it hasn't broken down. That stability basically keeps the status quo as dollar strong. Dollar strong equals weaker commodities. Generally, it weighs very heavily on commodities, especially crude oil. So the strength in the dollar, inventory is building every week consistently, and rig counts dropping, however production not dropping. These are very bearish figures. So there's a strong bearish argument. However, the bullish argument is not that bad either, hence the range in the market. Okay, so the bullish factors tend to change a little bit. However, the strength from the bulls is still definitely there. Market is technically oversold, so we are starting to stabilize, hence the prices tend to stabilize a little bit. So from a technical perspective, it's no surprise that the market is range bound, it's sideways. Okay, so that gives a little bit of fundamental strength. That gives a little bit of strength to the fundamental bulls. Okay, last week we had the Nigerian oil minister come out and say that she is going to look to ask for an emergency OPEC meeting if oil sustains itself below $60 for another few weeks, 4 to 6 weeks. Now Nigeria is really feeling the pain in the drop in oil prices. So is Venezuela, Ecuador, Algeria. All these countries are feeling the pain of the lower oil prices, primarily because they're higher cost producers. Okay, their break-even prices are much higher than the Gulf region, Saudi Arabia, Qatar, UAE, and the like. To give you an indication with Nigeria, Nigeria's production is somewhere in the region of about 2 million barrels. Ever since the Americans started producing their own crude oil, Nigeria has steadily, their exports to the United States have steadily decreased. So like in 2007, they were exporting in the region of about 1 million barrels to the United States. That dropped to about 239,000 in 2013, and then further down to about 54,000 last year. Currently, as we stand, there's not much being exported out to the US. So it's only natural if a country loses its existing customer due to the lower oil prices, they are going to look to try and do something to resume those export revenues that they're getting. Hence, they threatened the market with a potential OPEC meeting using the Financial Times last week. On the other hand, okay, obviously, of course, this made the oil prices rally. Okay, anything that oil ministers say generally will have an impact. However, we need to keep things in perspective. As things stand, the oil minister to really be listening out for is the Saudi oil minister, Mr. Al Naimi, simply because they're the largest swing producer. Okay, so hence they will be the most influential in the market. So generally, what the Minister Al Naimi has said is that OPEC will maintain production at about 30 million barrels as they see demand in 2015 to grow. Okay, and they actually back that up by announcing that they are, well, it's no new news, but what it is they're actually bringing online 3 new refineries that will be producing somewhere in the region of about 400,000 barrels each. Now this will take Saudi's production higher, significantly higher, and as it is, it's very high. But that will take their, their prowess in the markets, in the oil market, even higher. Okay, they've come in, basically they've come into partnership with a couple of companies, Total and a Chinese company as well, Sinopec, I believe. to build those refineries. So those are ongoing projects. Now, currently as we stand, Saudi produces 10 million barrels. They keep raising the amount of oil that they're producing. Okay, so they're backing up their view that oil prices are cheap. They said there's basically what they're saying is that the demand is there for the market for their oil products. Now, what is very interesting to me is that Aramco, their state-owned company, is bringing under review their further investment plans into their current projects. So, and possibly even terminating some of their drilling contracts. So this is very interesting information. On one hand, you've got them building new refineries, but on the other hand, Aramco is actually cutting down on their budgets. So the fact that they're looking to do this is of course bullish for the market. What Minister Al-Naimi is saying, there is demand in the market for their product. That's bullish for the market. He can move the market around on his speech. So what we have over here is a little bit of manipulation going on. Yes, oil is overextended. There is every reason for us to feel that we should be headed higher. But as things stand, the status quo has not changed. Both the bullish arguments are strong, the bearish arguments are strong, but that is typical for a market that is moving sideways. Okay, so what are my trading levels? Right, like I explained, the market at the moment is, and for the last couple of weeks, has been stuck in a range. Why is it in a range? Basically, both the fundamental and technical analysis shows you that the market is overextended. Fundamentally, we have strong data as well, strong arguments for both the bulls and the bears. Now, between 48.60 and about 53.94, that range is very prominent. Okay, I personally do not like to trade ranges. I find them quite unpredictable. You don't know when they're going to break out. So I'd rather trade the breakout itself. So what I have is what is known as a neutral zone. That neutral zone is what some of my colleagues call the battle zone. It's where the bulls and the bears are actually fighting it out. Okay, we let them fight, don't get involved. So what I'm doing is I'm actually on the sidelines. Part of risk management, part of money management is knowing when to trade and knowing when to sit on the sidelines. This is crucial. You can't always be engaged in the market. It's very, the marketplace has to be treated with respect. It is absolutely vital to know that when the market trading conditions are appropriate for your style of trading. So based on my style of trading, I'm happy sitting on the sidelines, letting these guys fight it out, and then trading that market. Now, to know my exact entry points, obviously I know generally where the levels, where the institutional trading levels are, where if those levels are breached, we then know generally should have an idea of who is in control of the market. So I'm patiently waiting for that moment. I'm waiting for those particular levels of mine to be broken. To find out exactly what those levels are, please use my contacts, get in touch with my team. The contacts will be displayed on the screen following. One of my team members will get in touch with you. We'll get out our oil report to you. My oil report does, clearly identify those exact levels. I even talk about exactly where to take profits on the particular trades. Like I said, the market can be traded in both directions. There's no need to get emotional about it. There's no need to, commit to one side unnecessarily, even when the market's going against you. So all we're waiting to do is waiting for a breakout, and then we're going to trade it. You can follow me on Twitter as well. I do share my opinion on what's going on in the market, live information as it comes out, so you can get really quick data for yourselves. So that is it for me for this week. Thank you for joining me once again. I look forward to seeing you next week, and I wish you a profitable trading week.